All right, hello my Econ students. We're here to go over worksheet number 20, our last worksheet. Again, hopefully you didn't shed too many tears over that. Again, I wish I was going around checking this in person, looking at your worksheets and giving you a hard time about it, but unfortunately we're not able to do that. So if any part of it doesn't make sense, hopefully this helps you guys out a little bit. Now, here's the thing. You notice we've got supply and demand for currency. Now, here's what's interesting. So the value of currency, sometimes you'll hear something about the value of the dollar has increased or decreased or whatever else. Now, people, because the value of currency changes, there are people out there who invest in currency in the same way that people say invest in stocks, right? You buy a stock, what do you hope happens? The value of the stock goes up, you trade the stock and you get more money than you started with. That would be a good thing. People do the same thing with currency. People buy currency, hoping that the value of the currency goes up. The value of the currency goes up. They sell it back. They get more money than what they started with. There are people that's their livelihood. They buy and sell currency. So it's kind of a cool thing, a little bit complicated, of course, but here's the bottom line, is you've got a supply and demand curve for, in this case, we're talking about the market for euros. Now, you notice these narratives here. I'm going to be honest, you don't really need to know the narratives. The narratives are just explaining why the demand curve for euros is downward sloping, like this, and why the supply curve of euros is upward sloping. Essentially, it's like every other supply and demand graph we've done all semester long. So if you just trust me that it looks like a normal supply and demand graph, that's all you really need to know. But if you don't trust me, as some of you probably don't, those narratives kind of explain why they look the way they do. But that being said, we don't really need to know that. What we really need to know, of course, is our equilibrium here. So, that's interesting. All right. So here we've got, of course, our equilibrium, and right now this is the dollar price of 1 euro. Okay, this is important. What that's indicating is how many dollars does it take, or how many dollars do you have to trade to get 1 euro. Okay, so keep that in mind here. So it says on the graph above, draw an increase in the demand for euros. So we start with, it takes $3 to get 1 euro. Okay, so if you're going to go to Europe and you want to get a euro, you have to give them $3 of our dollars to get that 1 euro to buy whatever you want to buy with that euro. Now, let's say that demand increases, like so. Okay, we'll call it D2. Now, notice here what happens to the price of a euro. It now takes more dollars to get that euro. Okay, now it takes $4 to get that euro. Now, does it take more or fewer dollars? Well, obviously, it used to take $3 to get the euro. Now it takes $4, so it takes more dollars to get that 1 euro. Now, here's the question. Does that cause the value of the euro to appreciate, mean increase in value, or depreciate? Now, here's how I like to do this. Okay, it can get confusing expressing the value of one currency in terms of another currency. That can kind of blow your mind a little bit. Here's what I like to do. I think it keeps it a little bit simpler. Try to liken this to something that you're more familiar with. I usually use a baseball card. It's pretty simple. So let's say that you had a baseball card. You could also say a stock. You could say anything. Let's say you had a baseball card. And the baseball card used to be worth $3. It used to take $3 to get that baseball card. Now it takes $4 to get the baseball card. Well, if your baseball card used to be worth $3, now it's worth $4, is your baseball card more or less valuable? That's right, it's more valuable. And if it's more valuable, you would say that your baseball card has appreciated. Well, the same thing is true of the euro, right? The euro has appreciated, okay, because now it takes more dollars to get the euro, just like it did the baseball card. Okay, the dollar, on the other hand, guess what? It has depreciated. Okay, if the euro has appreciated, the dollar has to have done the opposite. They can't do the same thing. They both can't appreciate or do. That'd be like saying, both teams won the game last night. Well, if one team wins, the other team loses, right? So if the euro has appreciated, the dollar, of course, has depreciated. Okay, it is less valuable because now it takes more dollars to get the same thing. And so like inflation, it would be less valuable. All right, let's look at a scenario where there is a decrease in demand for the euro. And we'll talk about why there'd be a change in demand for the euro in a second here. But just follow me on this for now. So it used to take $3 to get the euro. Now there's a decrease in demand, call it D2 for the euro. Now it takes, I didn't quite get to 2, but anyway, you get the idea, close to 2. So it used to take $3 to get the euro. Now it only takes $2 to get the euro. In this case, it takes fewer dollars to get the euro. Okay, and in that case, if you had a baseball card that used to be worth $3, now your baseball card's worth $2, you would say, oh no, my baseball card has lost value. Same thing is true here of the euro. The euro has depreciated. Okay, the dollar, conversely, of course, has appreciated. Okay, now to understand how this affects trade, okay, so you got to think of it from a traveler's perspective. Let's say a bottle of water in Europe costs €1. Okay, so you're going to Europe, you want to buy a bottle of water, it costs €1. Well, you have to give them $2 to get that euro. At least last year when you went to Europe, it took $2 to get the euro. Now you go back and you find that the exchange rate has changed and it takes $3 to get €1. Well, remember, if your baseball card used to be worth $2, now your baseball card is worth $3, it's more valuable. Same is true of the euro. The euro has become more valuable, it has appreciated. Okay, now, that being said, you used to have to give them $2 to get the euro to buy the water. Now you have to give them $3 to get the euro to buy the water. So from your perspective, a bottle of European water went from $2 to $3. Okay, does it now take more or less money to get that bottle of European water? It takes more American currency. Now, if it takes more American currency, does that make European water more or less expensive to us? Well, of course, it makes it more expensive to us. If European goods are more expensive to us, are we going to buy, would that make, okay, conversely, sorry, I got ahead of myself. Conversely, from a European's perspective, our stuff just became cheaper. Okay, it became less expensive because now when they come over here with their euro, they used to get $2, now they get $3 for that euro. So our stuff just became cheaper to them. So the question then is, their stuff is more expensive to us, our stuff is cheaper to them. Americans are going to import fewer European goods. Okay, so will America export more goods to Europe or import fewer European goods and import fewer, or are we going to import more and export less? Well, what we're going to end up doing is importing more, and I'm sorry, I'm getting this backwards. My apologies. All right, we're going to export more because remember, our stuff is cheaper, so Europe's going to buy our stuff, so we're going to export more, but we're not buying European goods. Okay, if we're not buying European goods, we're importing less. Okay, so when the euro appreciates, America will send more to Europe because our stuff's cheaper and buy fewer things from Europe because their stuff is more expensive. Now guess what? If the euro depreciates, it's going to be the exact opposite. Their stuff becomes cheaper, our stuff becomes more expensive, and so in that situation, we're going to import more and export less. Okay, I know that's a little bit tricky, but you always have to ask the question, where have things become more expensive versus where have things become cheaper? Okay, so that's what you want to look at when you do that. So that's how it affects trade. And then the last part of the worksheet, what are the things that cause demand to shift? Well, remember, you always want to ask the question, where do people want to buy? Okay, where do people want to buy from? Okay, do they want to buy from America or do they want to buy from Europe? Okay, so changes in tastes and preferences, this is pretty easy. Let's say that Europe makes better things than we do here in America, and so Americans want to buy European goods. If we want to buy their goods, do we need more or fewer euros from them? Well, to buy their goods, we need euros because that's what they want, right? Euros, so we got to get more euros. So it's going to take more euros to buy their goods, and that's going to increase the demand for euros. Okay, so kind of like what we did the first part of the graph on the front, we increase the demand for euros, that makes the euro appreciate. Okay, so bottom line is we want to buy more things from Europe, demand for that for European currency increases, and it makes the euro appreciate. All right, changes in inflation. Generally, the rule here is wherever inflation is lower, that's where people want to buy from because things are cheaper. If there's a nation that's getting a high rate of inflation, their stuff's getting more expensive, we don't want to buy from there. So, if Europe is experiencing a high rate of inflation, we're going to be like, we don't want to buy things from Europe. European goods are expensive, their prices keep going up. And so, in that case, our demand for euros will decrease. If we're not buying European goods, We don't need euros, and so demand is going to decrease for European goods. Okay, sloppy E, my apologies. Changes in income number 4. If Americans make more money, when you make more money, you tend to buy more or fewer things. Probably going to buy more things, right? Americans are no exception to that. So if we have more money, we're going to buy more of everything, including more goods from Europe. If we're buying more goods from Europe, demand for euros is going to increase because we need euros to buy their goods. And then lastly, changes in interest rates. So you got to think about this from the perspective of an investor. Okay, you're about to graduate high school in a little bit here. You're going to get a lot of graduation money, hopefully, and you bought into the Dave Ramsey thing, and you're like, you know, I don't want to invest this money. As an investor, you always want to go where interest rates are higher. That gets you a better return for your investment. Okay, so let's say the European stock market is getting a better rate of return than the American stock market. Where do you want to purchase stocks from? The European stock market. They're getting a better rate of return, and so you would need to buy more, or fewer, this should say, euros. We would want to buy more euros, okay, in order to buy their investment, and that would cause the demand for euros to increase. We need their euros in order to buy their stocks, okay? So the big thing from this is understanding, like on the front, the appreciation and depreciation. Again, I always try to put it in terms that make sense to you or that you understand. The second part is understanding how appreciation and depreciation affects trade. Okay, remember, if a country's currency appreciates, okay, their stuff becomes more expensive to other nations, and vice versa if it depreciates. And then the last part is what would cause demand to change for a currency, and it's based on one of these 4 things. Okay, and you always want to ask, again, you can summarize these 4 by just asking, where do people want to buy? Why would someone want to buy more from Europe or less from Europe? And these things will help you kind of rationalize that. So, as always, I know that's a little bit tricky. Currency exchange is just one of those kind of boogers of a concept, but hopefully that makes more sense. As always, if you have any questions, let me know. I'd be happy to help you out. We'll figure something out, but otherwise, until next time, behave yourselves.